Sam, given the step up in volatility, as well as the uncertainty that's coming out of Washington, how are you viewing risk with regard to equities nowadays?
Well, markets hate uncertainty, obviously, and we're seeing that. And they were so poorly positioned for uncertainty a year ago. Just back in December, believe it or not, we were sort of at max hubris. Everybody was all in on what I call, U.S. passive equity beta, mostly U.S. growth stocks. Everybody owned the same thing. We're now in the opposite area. So we're seeing volatility rise. We're seeing high yield spreads bounce. We're seeing correlations of stocks go up. Capital's heading to the exits, and we're seeing that. And so the big question is, when could we see some certainty come back and the capital sort of stabilize and not head for the exits so aggressively?
Okay, so when will we see certainty come back? What are you looking for to give you the confidence to go one way or the other in terms of direction in the equities market?
Well, the opposite. So I'm looking for high yield spreads to stabilize for sure, volatility to come down, and so that positioning to sort of get flatter. And we've seen already a lot has come out. Bank of America survey came out. It was the biggest decrease in U.S. equities that they've seen, survey to survey. So I think a lot of people are out, but we've got to get some stability in this tariff noise that we're seeing.
We've also seen growth pass the baton to value over the last few weeks. Do you think that value is going to take it from here? Because for the past few years, we've seen the Magnificent Seven and growth stocks really outperform value. And what kind of a signal would that be?
I definitely do. I think we're seeing a paradigm shift. I think we've been seeing it over the last year, but this is really accelerating it. And why? From an absolute standpoint, growth was pretty expensive. And again, the indexes were basically passive growth entities. You were at close to all-time valuation highs. If you look historically from these multiples, typically you were going to get low single-digit returns over sort of a decade. Goldman Sachs had put that out, and I think that's right. So you had to look elsewhere for returns. One of the big areas where that capital is going, it's going to value. Why? The relative value of value versus growth got to the cheapest it had ever been, the 100th percentile in 21. It'd been bouncing around in the cheapest 5%. That's a huge amount of potential energy if we get the shift. And you need a change. We're getting the change now in all this policy uncertainty. And as you said, the Russell 1000 value is more than 1,000 basis points ahead of growth so far this year. If you just get back to average, it's another 40% relative.
And at ClearBridge, you use something called a probability-focused approach. What exactly does that mean? And how do you apply it? Talk your book if you don't mind.
Yeah, sure. So everyone's looking for edge in markets, right? And our edge is we look at individual stocks and we say if we think the probability of a good outcome is better than what the market has priced, that difference in probability is edge. And if we get that edge, then our stocks go up. Price and value come together. The key thing here is that when we're right, we want to make a lot more money than we're wrong. Classic great risk reward, because we make mistakes. That's inevitable that that's going to happen, so we want to get paid for that. And then the final part of the probability, the future is unknown. But the only free lunch is diversification. We don't bet on one scenario in the portfolios. We run our process. We get these mispriced securities in. We diversify around and we can do well in a bunch of potential futures. And then when we get surprises like all this tariffs, all this noise, we can adapt the portfolio accordingly and change our minds. And so the key there is we build in our process probabilistically that we can change our minds, we can make mistakes, which is inevitable, and we constantly learn, which we think is how we win.
So before you change your mind, what is the process telling you right now? How are you positioned?
So last year, we were at max hubris. Again, the markets were very confident. So there were some things that were on sale, and we always look for future scenarios that are on sale. One is I really like commodities. Commodities are showing incredible capital discipline despite drill, baby, drill. They're not going to drill. You're seeing very high free cash flow yields, highest cash dividend yields in the market under energy. They have fortress balance sheets. They're earning good returns. And in my opinion, they're insurance for uncertainty. And the biggest uncertainty could be if we get this so-called Mar-a-Lago Accord. Every time you've seen a currency change like the Plaza Accord, commodities have gone on to be in a super cycle bull market, and we think that's a potential. The other is healthcare, worst performing sector last year. It was defense on sale, high single digit returns. We were able to get it when everybody felt great about the future in America. We really get that defense. Guess what's leading the market this year? Healthcare and energy, they're our two biggest sector bets.
And then finally, I think you mentioned before the Russell 1000 value as your benchmark. Why is this a good benchmark for what you do? And where are you right now? Are you trading below it? And if so, how much?
Yeah, so the index is probably around 17, 18 times, cheaper than the S&P 500, certainly. We're trading at around 12 times forward earnings. And the last several years, this is very typical. We've traded between 10 and 13 times forward earnings, yet we've generated double-digit returns. How? We have to get the fundamentals right. I like to buy growth and value wrappers. So we almost always have growth that's 50, 100% higher than the Russell 1000 value, but with a cheaper valuation. How are we able to do that? We find fundamentals where no one cares. Everybody owned the same stocks, US mega cap growth stocks. It left the ability to find great fundamentals and value wrappers, which is exactly what we do. You buy fundamentals when no one wants it, you let them compound, and it drives great returns.
All right, well, thanks a lot for coming on and talking about it.
Greg, pleasure.